Federal mortgage laws. What is the primary purpose of the Truth in Lending Act? Is it A, to regulate interest rates on loans? B, to ensure consumers are informed about credit terms? C, to provide tax benefits for mortgage interest? Or D, to standardize mortgage application processes? The answer is B, to ensure consumers are informed about credit terms. TILA is designed to promote informed use of consumer credit by requiring disclosures about terms and costs. It ensures consumers are aware of the true cost of borrowing. Under RESPA, which of the following is not a requirement for lenders? Is it A, provide a good faith estimate? B, disclose affiliated business arrangements? C, provide a credit score disclosure? Or D, provide a HUD-1 settlement statement? The answer is C, provide a credit score disclosure. Why this question may seem a bit tricky, RESPA has specific requirements, but it does not mandate lenders to provide a credit score disclosure, which is often confused with other disclosure requirements. Jane is applying for a mortgage and receives a loan estimate. What is the maximum number of business days the lender has to provide this after receiving her application? Is it A, 3 business days? B, 5 business days? C, 7 business days? Or D, 10 business days? The answer is A, 3 business days. The lender must provide the loan estimate within 3 business days of receiving the application, ensuring timely disclosure of loan terms. What does TRID stand for in the context of mortgage lending? Is it A, Truth in Real Estate Disclosure? B, Total Real Estate Information Disclosure? C, Truth in Lending and Real Estate Disclosure? Or D, TILA RESPA Integrated Disclosure? The answer is D, TILA RESPA Integrated Disclosure. TRID stands for TILA RESPA Integrated Disclosure, combining disclosures from TILA and RESPA into a simplified format. If a lender fails to provide a closing disclosure 3 business days before closing, what is the most likely consequence? Is it A, the borrower can waive the requirement? B, the closing must be delayed? C, a lender can proceed with verbal consent? Or D, the lender faces a fine but can proceed? The answer is B, the closing must be delayed. The closing must be delayed to ensure the borrower has 3 business days to review the closing disclosure, as required by TRID.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
What is the main purpose of the loan estimate under TRID regulations? Is it A, to finalize the loan terms? B, to inform borrowers of loan costs and terms? C, to replace the closing disclosure? Or D, to serve as a binding agreement? The answer is B, to inform borrowers of loan costs and terms. The loan estimate is designed to provide borrowers with clear and concise information about the costs and terms of a mortgage, allowing them to compare offers from different lenders. Under RESPA, when must a lender provide a borrower with a servicing disclosure statement? Is it A, at closing? B, after loan approval? C, within 3 business days of application? Or D, within 30 days of closing? The answer is C, within 3 business days of application. Why this question may seem a bit tricky, the timing of disclosures can be confusing. The servicing disclosure statement must be provided within 3 business days of receiving the loan application, not at closing or after approval. John is refinancing his home and receives a closing disclosure. How many business days must he wait before closing the loan? Is it A, 3 business days, B, 1 business day, C, 5 business days, or D, 7 business days? The answer is A, 3 business days. The TRID rule requires that the closing disclosure be provided at least 3 business days before the loan can close, allowing the borrower time to review the terms. Which of the following is not a requirement under the TILA RESPA Integrated Disclosure Rule? Is it A, providing a loan estimate, B, providing a closing disclosure, C, waiting 3 business days after the closing disclosure, or D, providing a good faith estimate? The answer is D, providing a good faith estimate. Why this question may seem a bit tricky, the TRID rule has specific requirements, and it's easy to confuse them with general lending practices. TRID does not require lenders to provide a good faith estimate, which was replaced by the loan estimate. Emily receives a revised loan estimate due to a change in her loan terms. How many business days does she have to review it before the lender can proceed? Is it A, 1 business day, B, 3 business days, C, 4 business days, or D, 7 business days? The answer is C, 4 business days. Under TRID, when a revised loan estimate is issued, the lender must wait at least 4 business days before proceeding to ensure the borrower has adequate time to review the changes. What is the primary purpose of the loan estimate under TRID regulations? Is it A, to provide a detailed breakdown of closing costs, B, to offer borrowers a clear understanding of loan terms and costs, C, to guarantee the interest rate for a specific period, or D, to replace the closing disclosure? The answer is B, to offer borrowers a clear understanding of loan terms and costs. The loan estimate is designed to provide borrowers with clear and concise information about the key features, costs, and risks of the mortgage loan they are applying for. Under RESPA, when must a lender provide a borrower with a good faith estimate? Is it A, within 3 business days of receiving the loan application, B, at least 7 business days before closing, C, the good faith estimate is no longer used, it's replaced by the loan estimate, or D, within 1 business day of receiving the loan application? The answer is C, the good faith estimate is no longer used, it's replaced by the loan estimate. Why this question may seem a bit tricky, the good faith estimate has been replaced by the loan estimate under TRID, but some may confuse the timing requirements. Lisa is buying a home and receives a closing disclosure. How many business days must she wait before closing the loan? Is it A, 3 business days, B, 5 business days, C, 1 business day, or D, 7 business days? The answer is A, 3 business days. The closing disclosure must be provided at least 3 business days before closing to give borrowers time to review the final terms and costs. What is the main purpose of the closing disclosure under TRID regulations? Is it A, to estimate the loan costs, B, to lock in the interest rate, C, to provide a summary of the loan application, or D, to confirm the final loan terms and costs? The answer is D, to confirm the final loan terms and costs. The closing disclosure provides the final details about the mortgage loan, including loan terms, projected monthly payments, and closing costs. Mark is refinancing his mortgage and receives a revised loan estimate due to a change in his loan terms. How many business days does he have to review it before the lender can proceed? Is it A, 2 business days, B, 4 business days, C, 1 business day, or D, 3 business days? The answer is B, 4 business days. When a revised loan estimate is issued, the borrower must receive it at least 4 business days before closing to ensure they have time to review the changes. What is the primary purpose of the TILA RESPA Integrated Disclosure Rule? Is it A, to increase lender profits through hidden fees? B, to eliminate the need for any mortgage disclosures? C, to simplify and consolidate mortgage disclosures for consumers? Or D, to provide lenders with more control over loan terms? The answer is C, to simplify and consolidate mortgage disclosures for consumers. The TRID rule aims to simplify and consolidate previous disclosure forms to improve consumer understanding and facilitate comparison shopping. Which of the following is a requirement under the TRID rule? Is it A, providing a good faith estimate within 3 days of application? B, providing a loan estimate within 3 business days of receiving a loan application? C, providing a closing disclosure at the time of application? Or D, providing a servicing disclosure statement within 3 days of application? The answer is B, providing a loan estimate within 3 business days of receiving a loan application. Why this question may seem a bit tricky, the TRID rule requires the use of specific forms and timing for disclosures, which can be confused with other regulatory requirements. Sarah is purchasing a home and receives a loan estimate. What should she expect regarding the accuracy of the costs listed? Is it A, the costs are estimates and may change slightly before closing? B, the costs are final and cannot change before closing? C, the costs are guaranteed and will be lower at closing? Or D, the costs are irrelevant as they will be recalculated at closing? The answer is A, the costs are estimates and may change slightly before closing. The loan estimate provides an estimate of costs, which should be accurate but can change slightly before closing.
Finding this exam review helpful? If you haven't already, like and subscribe for more videos that'll get you ready to pass.
ECOA, fair housing, and HMDA requirements. What is the primary purpose of the Home Mortgage Disclosure Act? Is it A, to regulate interest rates on mortgages? B, to provide public data on mortgage lending practices? C, to enforce anti-discrimination laws in housing? Or D, to set standards for mortgage loan qualifications? The answer is B, to provide public data on mortgage lending practices. The primary purpose of HMDA is to provide the public with information about how financial institutions are serving the housing needs of their communities. Under the Equal Credit Opportunity Act, which of the following is not a prohibited basis for credit discrimination? Is it A, race? B, marital status? C, employment status? Or D, national origin? The answer is C, employment status. Why this question may seem a bit tricky, the ECOA prohibits discrimination based on race, color, religion, national origin, sex, marital status, age, or because someone receives public assistance. Employment status is not explicitly protected under ECOA. A lender receives a mortgage application from a couple or one partner is on public assistance. What must the lender consider under ECOA? Is it A, consider public assistance income as valid income? B, reject the application due to unstable income? C, request additional documentation for public assistance? Or D, offer a higher interest rate due to perceived risk? The answer is A, consider public assistance income as valid income. Lenders must consider public assistance income as valid income under ECOA, ensuring fair treatment of applicants receiving such income. Which law requires lenders to provide borrowers with a copy of their appraisal report? Is it A, Fair Housing Act? B, Home Mortgage Disclosure Act, C. Real Estate Settlement Procedures Act, or D. Equal Credit Opportunity Act? The answer is D. Equal Credit Opportunity Act. The ECOA requires lenders to provide a copy of the appraisal report to borrowers promptly after it is completed. A real estate agent refuses to show homes in certain neighborhoods to a minority client. Which law is being violated? Is it A. Home Mortgage Disclosure Act, B. Fair Housing Act, C. Equal Credit Opportunity Act, or D. Community Reinvestment Act? The answer is B. Fair Housing Act. The Fair Housing Act prohibits discrimination in housing-related activities, including showing homes based on race or other protected characteristics. Under the Equal Credit Opportunity Act, which of the following is a prohibited basis for credit discrimination? Is it A. Credit score, B. Marital status, C. Employment history, or D. Loan amount? The answer is B. Marital status. ECOA prohibits discrimination based on race, color, religion, national origin, sex, marital status, age, or because someone receives public assistance. Which of the following actions is required by the Home Mortgage Disclosure Act for lenders? Is it A. Provide borrowers with their credit scores, B. Ensure equal lending opportunities, C. Offer the lowest possible interest rates, or D. Collect and report data on mortgage applications? The answer is D. Collect and report data on mortgage applications. Why this question may seem a bit tricky. HMDA requires lenders to collect and report data on mortgage applications, not to provide borrowers with credit scores or appraisals. A lender denies a mortgage application because the applicant is 70 years old. What law is potentially being violated in this scenario? Is it A. Equal Credit Opportunity Act, B. Fair Housing Act, C. Home Mortgage Disclosure Act, or D. Truth in Lending Act? The answer is A. Equal Credit Opportunity Act. ECOA prohibits discrimination based on age, so denying a loan solely due to the applicant's age could violate this law. Which law requires lenders to provide borrowers with a copy of their appraisal report? Is it A. Fair Housing Act, B. Home Mortgage Disclosure Act, C. Equal Credit Opportunity Act, or D. Real Estate Settlement Procedures Act? The answer is C. Equal Credit Opportunity Act. ECOA requires lenders to provide a copy of the appraisal report to borrowers promptly after it is completed. A real estate agent tells a client that a certain neighborhood is not suitable for them based on their ethnicity. Which law is being violated in this scenario? Is it A. Equal Credit Opportunity Act, B. Fair Housing Act, C. Home Mortgage Disclosure Act, or D. Truth in Lending Act? The answer is B. Fair Housing Act. The Fair Housing Act prohibits discrimination in housing based on race, color, national origin, religion, sex, familial status, or disability. Which of the following is a requirement under the Home Mortgage Disclosure Act? Is it A. Lenders must provide a copy of the appraisal report to borrowers, B. Lenders must report data on mortgage applications to federal agencies, C. Lenders must offer equal credit terms to all applicants, or D. Lenders must disclose interest rates to applicants? The answer is B. Lenders must report data on mortgage applications to federal agencies. HMDA requires lenders to collect and report data about mortgage applications to ensure transparency and prevent discrimination. A lender is reviewing a mortgage application from a single mother who receives child support. What must the lender consider under the Equal Credit Opportunity Act? Is it A. The lender can disregard child support as it is not a stable income, B. The lender should only consider employment income. C. A lender must consider child support as part of the applicant's income. Or D. A lender can offer different terms based on the applicant's marital status. The answer is C. The lender must consider child support as part of the applicant's income. ECOA requires lenders to consider all verifiable income sources, including child support, when assessing creditworthiness. FCRA, FACTA, and privacy disclosure rules. What is the primary purpose of the Fair Credit Reporting Act? Is it A, to ensure the accuracy and privacy of consumer information in credit reports? B, to regulate the interest rates on mortgage loans? C, to provide guidelines for mortgage loan disclosures? Or D, to establish standards for mortgage loan servicing? The answer is A, to ensure the accuracy and privacy of consumer information in credit reports. The FCRA aims to ensure the accuracy, fairness, and privacy of consumer information contained in the files of consumer reporting agencies. Under the FCRA, which of the following is not a right consumers have regarding their credit reports? Is it A, the right to dispute inaccurate information? B, the right to know what is in their credit report? C, the right to demand removal of accurate negative information? Or D, the right to receive a free credit report annually? The answer is C, the right to demand removal of accurate negative information. Why this question may seem a bit tricky. The FCRA provides many rights, but not all options listed are accurate. Consumers cannot demand removal of accurate negative information. John received a notice from his bank stating that his mortgage application was denied due to his credit report. What should John do first under the FCRA? Is it A, immediately apply for another mortgage with a different lender? B, request a free copy of his credit report to review the information? C, contact the bank to negotiate the terms of the mortgage? Or D, file a complaint with the Consumer Financial Protection Bureau? The answer is B, request a free copy of his credit report to review the information. John should first obtain a free copy of his credit report to verify the information that led to the denial. What does the Fair and Accurate Credit Transactions Act primarily address? Is it A, regulation of mortgage interest rates? B, guidelines for mortgage loan disclosures? C, standards for mortgage loan servicing? Or D, identity theft prevention and consumer access to credit information? The answer is D, identity theft prevention and consumer access to credit information. FACTA primarily addresses identity theft and consumer rights to access their credit information. Lisa notices an unfamiliar account on her credit report. According to FACTA, what is her best course of action? Is it A, dispute the unfamiliar account with the credit reporting agency? B, ignore it, assuming it will be corrected automatically? C, contact the lender directly to close the account? Or D, wait for the annual credit report to see if it persists? The answer is A, dispute the unfamiliar account with the credit reporting agency. Lisa should immediately dispute the unfamiliar account with the credit reporting agency to initiate an investigation. What is the primary purpose of the Fair and Accurate Credit Transactions Act? Is it A, to enhance consumer protections against identity theft and ensure credit report accuracy? B, to regulate the interest rates on mortgage loans? C, to establish guidelines for mortgage loan disclosures? Or D, to provide tax benefits for first-time homebuyers? The answer is A, to enhance consumer protections against identity theft and ensure credit report accuracy. FACTA aims to enhance consumer protections by ensuring the accuracy of credit reports and preventing identity theft. Under the FCRA, Which of the following entities is not considered a consumer reporting agency? Is it A, Equifax, B, Experian, C, a bank using credit reports for loan decisions, or D, TransUnion? The answer is C, a bank using credit reports for loan decisions. Why this question may seem a bit tricky. The term consumer reporting agency can be misunderstood. A bank using credit reports is not a reporting agency, it is a user of such reports. Sarah finds an error on her credit report and contacts the credit bureau to dispute it. What is the credit bureau's obligation under the FCRA? Is it A, ignore the dispute if it seems trivial, B, investigate the dispute within 30 days, C, immediately remove the disputed information, or D, charge Sarah a fee for processing the dispute? The answer is B, investigate the dispute within 30 days. The credit bureau must investigate the dispute within 30 days, ensuring the accuracy of the information. Which of the following is a requirement under FACTA for businesses that dispose of consumer information? Is it A, retain all consumer information for at least 7 years, B, provide consumers with a copy of disposed information, C, notify consumers before disposing of their information, or D, ensure the information is destroyed to prevent unauthorized access? The answer is D, ensure the information is destroyed to prevent unauthorized access. Why this question may seem a bit tricky. The requirement is specific to disposal methods, which must protect against unauthorized access. Tom receives a notice from his lender about a change in terms due to his credit report. What must the lender provide under the FCRA? Is it A, an adverse action notice detailing the decision and consumer rights, B, a copy of the credit report used in the decision, C, a refund of any application fees paid, or D, a detailed explanation of the lender's internal scoring model? The answer is A, an adverse action notice detailing the decision and consumer rights. The lender must provide an adverse action notice explaining the decision and the consumer's rights.
Notice the code in the corner? When you're stumped by a question, enter it at Birdsy.ai for immediate help. Enjoy complimentary study sessions and access to hundreds of additional questions to help you pass your exam with confidence.
General mortgage knowledge. What is the minimum down payment required for a conventional loan? Is it A, 0%, B, 3%, C, 5%, or D, 10%? The answer is B, 3%. Conventional loans typically require a minimum down payment of 3%, although some lenders may require more depending on the borrower's credit profile. Which loan type requires a funding fee that can be financed into the loan amount? Is it A, conventional, B, FHA, C, VA, or D, USDA? The answer is C, VA. Why this question may seem a bit tricky. The VA loan is unique in allowing the funding fee to be financed, unlike FHA or USDA loans, which have different fee structures. John, a veteran, is looking to buy a home with no down payment. Which loan product is most suitable for him? Is it A, VA, B, FHA, C, USDA, or D, conventional? The answer is A, VA. VA loans are specifically designed for veterans and offer the benefit of no down payment, making them ideal for John's situation. Which loan type is specifically designed for rural property buyers? Is it A, conventional, B, FHA, C, VA, or D, USDA? The answer is D, USDA. USDA loans are intended for rural property buyers and offer benefits like no down payment for eligible applicants. Emily is purchasing her first home and has limited funds for a down payment. Which loan option might best suit her needs? Is it A, conventional, B, FHA, C, VA, or D, USDA? The answer is B, FHA. FHA loans are popular among first-time homebuyers due to their low down payment requirement of 3.5%, which suits Emily's situation. What is the primary benefit of a USDA loan for eligible borrowers? Is it A, lower interest rates than conventional loans, B, no down payment requirement, C, no mortgage insurance required, or D, available for any property type? The answer is B, no down payment requirement. USDA loans offer the benefit of no down payment, making them attractive for eligible rural and suburban homebuyers. Which loan type typically requires private mortgage insurance if the down payment is less than 20%? Is it A, conventional loans, B, FHA loans, C, VA loans, or D, USDA loans? The answer is A, conventional loans. Why this question may seem a bit tricky. FHA loans require mortgage insurance, but it's not called PMI. Conventional loans require PMI with less than 20% down. Sarah is buying a home in a rural area and wants to avoid a down payment. Which loan product should she consider? Is it A, conventional loan, B, FHA loan, C, VA loan, or D, USDA loan? The answer is D, USDA loan. USDA loans are designed for rural properties and offer the benefit of no down payment, making them ideal for Sarah's situation. What is a key feature of an FHA loan? Is it A, no mortgage insurance required, B, available only to first-time homebuyers, C, low down payment requirement, or D, no credit check required? The answer is C, low down payment requirement. FHA loans are known for their low down payment requirement, making them accessible to more borrowers. Mike, a veteran, wants to purchase a home with no down payment and avoid mortgage insurance. Which loan should he choose? Is it A, conventional loan, B, FHA loan, C, VA loan, or D, USDA loan? The answer is C, VA loan. VA loans are ideal for veterans, like Mike, offering no down payment and no mortgage insurance requirement. What is the primary purpose of private mortgage insurance in conventional loans? Is it A, to reduce the interest rate for the borrower, B, to cover closing costs for the borrower, C, to protect the lender in case of borrower default, or D, to increase the loan amount available to the borrower? The answer is C, to protect the lender in case of borrower default. PMI protects the lender in case the borrower defaults on the loan. It is typically required when the down payment is less than 20%. Which loan type allows for the possibility of no down payment and no private mortgage insurance? Is it A, VA loan, B, FHA loan, C, conventional loan, or D, USDA loan? The answer is A, VA loan. Why this question may seem a bit tricky. VA loans offer no down payment and no PMI, but other loans might seem similar due to low down payment options. Lisa is buying a home in a suburban area and has a credit score of 580. Which loan product is most likely to accommodate her situation? Is it A, conventional loan, B, FHA loan, C, VA loan, or D, USDA loan? The answer is B, FHA loan. FHA loans are more lenient with credit scores, often accepting scores as low as 580 with a 3.5% down payment. Which loan type typically requires an upfront mortgage insurance premium? Is it A, conventional loan, B, FHA loan, C, VA loan, or D, USDA loan? The answer is B, FHA loan. FHA loans require an upfront mortgage insurance premium at closing, in addition to monthly insurance premiums. Tom is a first-time homebuyer with a stable income but limited savings. He wants to minimize his down payment. Which loan option might best suit his needs? Is it A, conventional loan, B, VA loan, C, FHA loan, or D, USDA loan? The answer is C, FHA loan. FHA loans are ideal for first-time buyers with limited savings, requiring only a 3.5% down payment. Fixed ARM, non-traditional, and QM non-QM features. What is a key characteristic of a non-qualified mortgage, non-QM? Is it A, they always have fixed interest rates, B, they may not meet the standard debt-to-income ratio requirements, C, they are guaranteed by the government, or D, they require a 20% down payment? The answer is B, they may not meet the standard debt-to-income ratio requirements. Non-QM loans do not meet the standard criteria for a qualified mortgage, often due to non-traditional income verification or higher debt-to-income ratios. Which feature is not typically associated with non-QM loans? Is it A, alternative income verification methods, B, higher interest rates than QM loans, C, government insurance backing, or D, flexible debt-to-income ratios? The answer is C, government insurance backing. Why this question may seem a bit tricky. Non-QM loans can have various features, but they do not typically include government insurance, which is common in FHA or VA loans. John is applying for a mortgage but has a high debt-to-income ratio and irregular income. Which type of mortgage is he most likely to qualify for? Is it A, conventional QM loan, B, FHA loan, C, VA loan, or D, non-QM loan? The answer is D, non-QM loan. Non-QM loans are designed for borrowers like John who have non-traditional income or higher debt-to-income ratios. Which of the following is a common feature of non-QM loans? Is it A, interest-only payment options, B, strict income documentation requirements, C, government-backed guarantees, or D, standardized underwriting guidelines? The answer is A, interest-only payment options. Non-QM loans often feature interest-only payments, allowing borrowers to pay only the interest for a set period. What is a potential drawback of choosing a non-QM loan? Is it A, limited lender options, B, higher interest rates, C, mandatory government insurance, or D, fixed payment schedules? The answer is B, higher interest rates. Why this question may seem a bit tricky. While non-QM loans offer flexibility, they often come with higher interest rates due to increased risk. What is a common feature of non-qualified mortgages, non-QM? Is it A, interest-only payments, B, strict income verification, C, fixed interest rates, or D, government backing? The answer is A, interest-only payments. Non-QM loans often feature interest-only payments, which allow borrowers to pay only the interest for a set period, reducing initial monthly payments. Which of the following is a feature that might make a loan non-qualifying? Is it A, fixed monthly payments, B, balloon payment, C, low down payment, or D, government insurance? The answer is B, balloon payment. Why this question may seem a bit tricky. The term balloon payment can be misleading, as it suggests a large final payment, which is a feature of some non-QM loans. Lisa is self-employed with fluctuating income and seeks a mortgage. Which feature is she likely to encounter in a non-QM loan? Is it A, strict credit score requirements, B, government-backed security, C, alternative income verification, or D, fixed interest rate? The answer is C, alternative income verification. Non-QM loans often offer alternative income verification methods, which can benefit self-employed individuals like Lisa. Which type of mortgage is typically not considered a qualified mortgage? Is it A, 30-year fixed-rate mortgage, B, adjustable rate mortgage, C, FHA loan, or D, interest-only loan? The answer is D, interest-only loan. Interest-only loans are typically not considered QM because they do not require principal repayment during the interest-only period. Tom is considering a mortgage that allows him to pay only the interest for the first 5 years. What type of loan is this likely to be? Is it A, fixed-rate mortgage, B, non-QM loan, C, government-backed loan, or D, traditional ARM? The answer is B, non-QM loan. Interest-only payment options are a hallmark of non-QM loans, which offer flexibility in initial payment structures. What is a common feature of a non-qualified mortgage, non-QM? Is it A, fixed interest rates, B, interest-only payment options, C, strict income verification, or D, low debt-to-income ratio requirements? The answer is B, interest-only payment options. Non-QM loans often include features like interest-only payments, which are not allowed in qualified mortgages. Which feature might make a mortgage non-qualifying under QM standards? Is it A, adjustable interest rates, B, low down payment, C, balloon payments, or D, fixed interest rates? The answer is C, balloon payments. Why this question may seem a bit tricky. Balloon payments can disqualify a loan from being a QM, but they are sometimes confused with adjustable rates or interest-only payments. Sarah is self-employed and has a fluctuating income. She is considering a mortgage that allows for interest-only payments initially. What type of mortgage is she likely considering? Is it A, fixed-rate mortgage, B, adjustable rate mortgage, C, qualified mortgage, or D, non-qualified mortgage? The answer is D, non-qualified mortgage. Interest-only payment options are a feature of non-QM loans, which cater to borrowers like Sarah with non-traditional income. Which of the following is a characteristic of non-QM loans? Is it A, flexible underwriting standards, B, strict debt-to-income limits, C, mandatory fixed interest rates, or D, government insurance? The answer is A, flexible underwriting standards. Non-QM loans often have flexible underwriting standards allowing for alternative income verification methods. Mark is looking for a mortgage that allows him to verify his income through bank statements rather than traditional pay stubs. Which type of mortgage is he likely considering? Is it A, fixed-rate mortgage, B, non-qualified mortgage, C, qualified mortgage, or D, adjustable rate mortgage? The answer is B, non-qualified mortgage. Non-QM loans often allow for alternative income verification methods, such as bank statements, which is suitable for Mark's needs.
Finding this exam review helpful? If you haven't already, like and subscribe for more videos that'll get you ready to pass.
Mortgage math, DTI, LTV, CLTV, qualifying income. What does the acronym LTV stand for in mortgage terms? Is it A, loan to value, B, loan to vendor, C, lease to value, or D, lease to vendor? The answer is A, loan to value. LTV stands for loan to value ratio, which is a financial term used by lenders to express the ratio of a loan to the value of an asset purchased. If a borrower has a monthly gross income of $5,000 and monthly debt obligations of $1,500, what is their debt-to-income ratio? Is it A, 20%, B, 25%, C, 30%, or D, 35%? The answer is C, 30%. Why this question may seem a bit tricky, the DTI ratio is calculated by dividing total monthly debt by gross monthly income, not net income. John is buying a home valued at $200,000 with a down payment of $40,000. What is his loan-to-value ratio? Is it A, 20%, B, 80%, C, 60%, or D, 50%? The answer is B, 80%. The LTV ratio is calculated by dividing the loan amount by the appraised value of the property. What is the primary purpose of calculating the combined loan-to-value ratio? Is it A, to determine the interest rate, B, to calculate monthly payments, C, to assess property taxes, or D, to evaluate total loan risk? The answer is D, to evaluate total loan risk. CLTV is used to assess the total risk of all loans on a property relative to its value. Sarah earns $4,000 monthly and has a car loan payment of $300 and a student loan payment of $200. What is her debt-to-income ratio? Is it A, 12.5%, B, 15%, C, 20%, or D, 25%? The answer is A, 12.5%. DTI is calculated by dividing total monthly debt payments by gross monthly income. What does the acronym DTI stand for in mortgage terms? Is it A, debt to interest, B, debt to income, C, deposit to income, or D, down payment to income? The answer is B, debt to income. DTI stands for debt-to-income ratio, which is a measure of a borrower's monthly debt payments compared to their gross monthly income. If a borrower has a monthly gross income of $6,000 and monthly debt obligations of $2,000, what is their debt-to-income ratio? Is it A, 25%, B, 30%, C, 33.33%, or D, 40%? The answer is C, 33.33%. Why this question may seem a bit tricky, the DTI ratio is calculated by dividing total monthly debt by gross monthly income, then multiplying by 100 to get a percentage. Emily is purchasing a home valued at $300,000 with a down payment of $60,000. What is her loan-to-value ratio? Is it A, 80%, B, 75%, C, 85%, or D, 90%? The answer is A, 80%. The LTV ratio is calculated by dividing the loan amount by the property value. Here, the loan amount is $240,000, making the LTV 80%. What is the primary purpose of calculating the loan-to-value ratio? Is it A, to assess the risk of a loan, B, to determine the borrower's credit score, C, to calculate the interest rate, or D, to establish the loan term? The answer is A, to assess the risk of a loan. The LTV ratio helps lenders assess the risk of a loan by comparing the loan amount to the appraised value of the property. Michael earns $5,500 monthly and has a mortgage payment of $1,200, a car loan of $400, and credit card payments totaling $300. What is his debt-to-income ratio? Is it A, 30%, B, 34.55%, C, 36%, or D, 40%? The answer is B, 34.55%. Michael's total monthly debt is $1,900. Dividing this by his income of $5,500 gives a DTI of 34.55%. Mortgage origination activities. What is the primary purpose of a mortgage loan application? Is it A, to collect information about the borrower and the property, B, to determine the interest rate for the loan, C, to finalize the loan agreement, or D, to provide legal documentation for the property? The answer is A, to collect information about the borrower and the property. The primary purpose of a mortgage loan application is to collect information about the borrower and the property to assess the borrower's ability to repay the loan. Which document is typically required to verify a borrower's income during the underwriting process? Is it A, bank statements, B, pay stubs, C, credit reports, or D, property appraisal? The answer is B, pay stubs. Why this question may seem a bit tricky. Tax returns and pay stubs are both used, but pay stubs are more commonly requested for immediate income verification. John is applying for a mortgage and has provided all necessary documents except his employment verification. What should the underwriter do next? Is it A, approve the loan based on available documents, B, reject the loan application, C, request employment verification from John, or D, proceed with a conditional approval? The answer is C, request employment verification from John. The underwriter should request employment verification to ensure John's income is stable and sufficient for loan approval. What is the role of an underwriter in the mortgage origination process? Is it A, to market mortgage products to potential borrowers, B, to collect application documents from borrowers, C, to finalize the loan agreement with the borrower, or D, to assess the risk of lending to a borrower? The answer is D, to assess the risk of lending to a borrower. The underwriter evaluates the risk of lending to a borrower by assessing their financial information and the property's value. Emily, a loan officer, receives an application from a borrower with a high debt-to-income ratio. What should she consider before submitting the application to underwriting? Is it A, submit the application without any changes, B, evaluate compensating factors like credit score and assets, C, advise the borrower to reduce their debt immediately, or D, request a higher interest rate to offset the risk? The answer is B, evaluate compensating factors like credit score and assets. Emily should consider whether the borrower has compensating factors, such as a high credit score or significant assets, to offset the high debt-to-income ratio. What is the primary document used to assess a borrower's creditworthiness during the underwriting process? Is it A, loan estimate, B, credit report, C, title insurance, or D, appraisal report? The answer is B, credit report. The credit report is the main document used to evaluate a borrower's creditworthiness, providing a detailed history of their credit behavior. Why might an underwriter request a verification of employment form? Is it A, to verify the borrower's credit score, B, to assess the property's market value, C, to confirm the borrower's employment and income, or D, to determine the borrower's debt-to-income ratio? The answer is C, to confirm the borrower's employment and income. Why this question may seem a bit tricky. While income verification is crucial, the VUE specifically confirms employment status and income consistency. Sarah, a loan officer, receives an application from a borrower with inconsistent income documentation. What should she do before submitting the application to underwriting? Is it A, submit the application as is, B, ignore the inconsistencies, C, estimate the income based on available data, or D, request additional documentation? The answer is D, request additional documentation. Sarah should request additional documentation to clarify income inconsistencies, ensuring the underwriter has accurate information. Which factor is least likely to affect a borrower's ability to qualify for a mortgage? Is it A, marital status, B, credit score, C, debt-to-income ratio, or D, employment history? The answer is A, marital status. Why this question may seem a bit tricky. While all factors are important, the borrower's marital status typically has the least direct impact on mortgage qualification. During the underwriting process, what is the purpose of a property appraisal? Is it A, to verify the borrower's income, B, to assess the borrower's creditworthiness, C, to determine the property's market value, or D, to confirm the borrower's employment? The answer is C, to determine the property's market value. An appraisal determines the property's market value, ensuring it meets or exceeds the loan amount. What is the primary purpose of a credit report in the mortgage underwriting process? Is it A, to verify the borrower's employment history, B, to evaluate the borrower's creditworthiness, C, to determine the property's market value, or D, to confirm the borrower's income? The answer is B, to evaluate the borrower's creditworthiness. A credit report is used to assess a borrower's creditworthiness by providing a detailed history of their credit behavior, which helps underwriters evaluate the risk of lending. In mortgage underwriting, which factor is most critical in determining a borrower's ability to repay the loan? Is it A, credit score, B, employment history, C, debt-to-income ratio, or D, loan-to-value ratio? The answer is C, debt-to-income ratio. Why this question may seem a bit tricky. While credit score and employment history are important, the debt-to-income ratio is a key indicator of a borrower's ability to manage monthly payments. Lisa, an underwriter, receives an application where the borrower's income is primarily from freelance work. What should Lisa focus on to assess the borrower's income stability? Is it A, reviewing tax returns over multiple years, B, checking the borrower's credit score, C, verifying current bank statements, or D, assessing the borrower's current employment contract? The answer is A, reviewing tax returns over multiple years. Freelance income can be irregular, so reviewing tax returns over multiple years helps assess consistency and stability. Tom, a loan officer, is reviewing an application where the borrower has a high loan-to-value ratio. What should Tom consider before proceeding? Is it A, the borrower's employment stability, B, the borrower's credit history, C, the property's appraisal value, or D, whether the borrower has mortgage insurance? The answer is D, whether the borrower has mortgage insurance. A high loan-to-value ratio indicates higher risk, so Tom should consider if the borrower has mortgage insurance to mitigate this risk. Appraisals, valuation, and collateral review. What is the primary purpose of an appraisal in the mortgage origination process? Is it A, to assess the borrower's creditworthiness, B, to determine the market value of the property, C, to verify the borrower's income, or D, to inspect the structural integrity of the property? The answer is B, to determine the market value of the property. An appraisal is primarily used to determine the market value of a property, ensuring that the loan amount is appropriate for the property's worth. Which factor is least likely to affect a property's appraised value? Is it A, location of the property, B, recent sales of similar properties, C, condition of the property, or D, appraiser's personal opinion? The answer is D, appraiser's personal opinion. Why this question may seem a bit tricky. All options seem relevant, but the appraiser's personal opinion should not influence the objective market value. John is applying for a mortgage, and the appraiser notes that the property has a unique architectural style, uncommon in the area. How might this affect the appraisal process? Is it A, the appraisal will be rejected due to lack of comparables, B, the property will be appraised at a lower value automatically, C, the appraiser may need to find additional comparables or make adjustments, or D, the appraisal will be based solely on construction costs? The answer is C, the appraiser may need to find additional comparables or make adjustments. Unique properties may require adjustments or additional comparables as they don't fit typical market comparisons. What is a comparable sale in the context of property appraisals? Is it A, a recently sold property similar to the subject property, B, a property listed for sale in the same neighborhood, C, a property with the same architectural style, or D, a property with the same assessed tax value? The answer is A, a recently sold property similar to the subject property. A comparable sale is a recently sold property similar in size, location, and features to the subject property, used to help determine its value. Emily is reviewing an appraisal report and notices that the appraiser used 3 comparables, all from different neighborhoods. What should she consider regarding the appraisal's reliability? Is it A, the appraisal is invalid due to neighborhood differences, B, the appraisal may be less reliable due to differing market conditions, C, the appraisal is more reliable due to diverse comparables, or D, the appraisal should be redone with more comparables? The answer is B, the appraisal may be less reliable due to differing market conditions. Using comparables from different neighborhoods may affect reliability due to varying market conditions. What is the role of a property appraisal in the mortgage origination process? Is it A, to determine the buyer's creditworthiness, B, to establish the property's tax value, C, to estimate the property's market value, or D, to finalize the sale price of the property? The answer is C, to estimate the property's market value. An appraisal provides an unbiased estimate of a property's market value, which helps lenders determine the loan amount they are willing to offer. Which element is most crucial in determining the reliability of an appraisal report? Is it A, the age of the property, B, the appraiser's qualifications, C, the size of the property, or D, the number of comparable sales used? The answer is B, the appraiser's qualifications. Why this question may seem a bit tricky. While all elements are important, the appraiser's qualifications are crucial as they ensure the appraisal is conducted professionally and accurately. Sarah is reviewing an appraisal report where the appraiser used comparables from a neighboring city due to a lack of local sales. What should she consider about the appraisal's accuracy? Is it A, the appraisal is invalid due to non-local comparables? B, the appraisal is more accurate due to diverse comparables? C, the appraisal is unaffected by the location of comparables? Or D, the appraisal's accuracy may be compromised due to differing market conditions? The answer is D. The appraisal's accuracy may be compromised due to differing market conditions. Using comparables from a different area can affect accuracy due to differing market conditions, so Sarah should consider this when evaluating the report. What is a comparable sale in property appraisals? Is it A, a recently sold property similar to the subject property? B, a property listed for sale in the same neighborhood? C, a property with the same tax assessment value? Or D, a property with the same construction year? The answer is A, a recently sold property similar to the subject property. A comparable sale is a recently sold property similar in size, location, and features to the subject property, used to estimate its market value. During a property appraisal, the appraiser notes significant renovations that were not permitted. How might this impact the appraisal? Is it A, the renovations will increase the property's appraised value? B, the renovations may lower the property's appraised value? C, the appraiser will ignore the renovations? Or D, the appraiser will adjust the value based on local market trends? The answer is B, the renovations may lower the property's appraised value. Unpermitted renovations can affect the appraisal by potentially lowering the property's value due to legal and safety concerns. Closing, funding, rescission, and post-closing. What is the primary purpose of the rescission period in mortgage transactions? Is it A, to finalize the loan terms with the lender? B, to ensure the lender can verify all documents? C, to give borrowers time to cancel the loan? Or D, to allow for the disbursement of funds? The answer is C, to give borrowers time to cancel the loan. The rescission period allows borrowers to reconsider and cancel the loan agreement without penalty, providing a safeguard against hasty decisions. Which of the following actions can a borrower take during the rescission period? Is it A, request a change in interest rate? B, cancel the loan agreement? C, receive the loan funds? Or D, sign additional loan documents? The answer is B, cancel the loan agreement. Why this question may seem a bit tricky. Borrowers might think they can negotiate terms, but the rescission period is solely for cancellation. John has just closed on a mortgage and is in the rescission period. What should he do if he decides not to proceed with the loan? Is it A, notify the lender in writing to cancel the loan? B, contact the title company to stop the process? C, wait for the rescission period to end and then inform the lender? Or D, sign a new loan agreement with different terms? The answer is A, notify the lender in writing to cancel the loan. John must notify the lender in writing to cancel the loan during the rescission period. What happens to the loan funds during the rescission period? Is it A, they are immediately dispersed to the borrower? B, they are used to pay closing costs? C, they are returned to the lender? Or D, they are held until the rescission period ends? The answer is D, they are held until the rescission period ends. During the rescission period, loan funds are held and not dispersed until the period ends without cancellation. Lisa is closing on her mortgage and is informed about the rescission period. What should she be aware of regarding this period? Is it A, she can negotiate a lower interest rate during this time? B, she must sign additional documents to finalize the loan. C. She can cancel the loan without penalty. Or D. The loan funds will be dispersed immediately. The answer is C. She can cancel the loan without penalty. Lisa should know that the rescission period allows her to cancel the loan without penalty. What is the primary function of the closing disclosure in a mortgage transaction? Is it A. to initiate the rescission period? B. to outline the final loan terms and costs? C. to determine the borrower's creditworthiness? Or D. to finalize the loan application? The answer is B. to outline the final loan terms and costs. The closing disclosure provides the borrower with a detailed account of the final loan terms and costs, ensuring transparency before the loan is finalized. During the rescission period, what happens to the loan funds? Is it A. they are immediately dispersed to the borrower? B. they are held in escrow? C. they are not dispersed until the rescission period ends? Or D. they are returned to the lender? The answer is C. They are not dispersed until the rescission period ends. Why this question may seem a bit tricky. The loan funds are not dispersed until the rescission period ends, which can be confusing, as some might think they are held in escrow. Sarah has just closed on her mortgage and is considering rescinding the loan. What must she do to effectively cancel the transaction? Is it A. provide written notice to the lender within the rescission period? B. call the lender to verbally cancel the loan? C. wait for the lender to contact her about cancellation? Or D. do nothing and assume the loan will be canceled automatically? The answer is A. provide written notice to the lender within the rescission period. Sarah must provide written notice to the lender within the rescission period to effectively cancel the transaction. Ethics and professional conduct. What is a common red flag that may indicate potential mortgage fraud? Is it A. a consistent employment history? B. a sudden increase in income without documentation? C. a high credit score? Or D. a large down payment? The answer is B. a sudden increase in income without documentation. A sudden increase in income without documentation is a common red flag for mortgage fraud, as it may indicate falsified income information. Which of the following actions could be considered misrepresentation in mortgage lending? Is it A. providing a detailed employment history? B. submitting a loan application? C. stating a false property value? Or D. requesting a credit report? The answer is C. stating a false property value. Why this question may seem a bit tricky. Misrepresentation involves providing false information. Stating a false property value is a direct form of misrepresentation. John, a mortgage loan originator, notices that a client's income documents appear altered. What should John do to adhere to ethical standards? Is it A. report the suspicious documents to the compliance department? B. ignore the issue and proceed with the application? C. alter the documents to make them appear legitimate? Or D. ask the client to provide new documents without reporting? The answer is A. report the suspicious documents to the compliance department. John should report the suspicious documents to his compliance department to ensure due diligence and maintain ethical standards. What is the primary purpose of fraud detection in mortgage lending? Is it A. to increase loan approval rates? B. to reduce paperwork? C. to enhance customer satisfaction? Or D. to protect the integrity of the financial system? The answer is D. to protect the integrity of the financial system. The primary purpose of fraud detection is to protect the integrity of the financial system by preventing fraudulent activities. Emily, a loan officer, receives an application with inconsistent employment history. What is the most appropriate action for Emily to take? Is it A. Approve the application based on other strong factors. B. Verify the employment details for accuracy. C. Reject the application immediately. Or D. Ignore the inconsistency and proceed. The answer is B. Verify the employment details for accuracy. Emily should verify the employment details to ensure the information provided is accurate and prevent potential fraud. Which of the following is a key indicator of potential fraud in mortgage applications? Is it A. High credit score, B. Inconsistent information across documents, C. Low debt-to-income ratio, or D. Multiple bank accounts? The answer is B. Inconsistent information across documents. Inconsistent information across documents is a common red flag for fraud, as it suggests possible manipulation or misrepresentation. What might be a misleading sign of fraud in a mortgage application? Is it A. Applicant's long employment history, B. Applicant's high income, C. Unexplained large down payment, or D. Applicant's low credit utilization? The answer is C. Unexplained large down payment. Why this question may seem a bit tricky. A large down payment might suggest financial stability, but if unexplained, it could raise questions about the source of funds. Sarah, a loan officer, receives an application with a social security number that matches another applicant. What should Sarah do to ensure compliance with ethical standards? Is it A. Verify the social security number, B. Approve the application based on other strong credentials, C. Ignore the discrepancy if the credit score is high, or D. Request a higher down payment to mitigate risk? The answer is A. Verify the social security number. Sarah should verify the social security number to ensure it is not a case of identity theft or misrepresentation. What is a common method used to detect fraud in mortgage applications? Is it A. Relying solely on applicant-provided documents, B. Approving applications with high credit scores automatically, C. Ignoring minor discrepancies in documentation, or D. Cross-referencing information with third-party sources? The answer is D. Cross-referencing information with third-party sources. Cross-referencing information with third-party sources helps verify the accuracy of the applicant's information and detect inconsistencies. Tom, a mortgage broker, finds that an applicant's stated income does not match their tax returns. What is the most appropriate action for Tom to take? Is it A. Approve the loan based on the stated income, B. Request additional documentation to clarify the discrepancy, C. Ignore the discrepancy if the applicant has a good credit score, or D. Report the applicant to authorities immediately? The answer is B. Request additional documentation to clarify the discrepancy. Tom should request additional documentation to clarify the income discrepancy, ensuring accurate and ethical processing. Consumer protection, steering, and fair lending. What is the primary purpose of the Equal Credit Opportunity Act? Is it A. To regulate interest rates on loans, B. To prevent discrimination in credit transactions, C. To provide guidelines for mortgage insurance, or D. To establish fair housing practices? The answer is B. To prevent discrimination in credit transactions. The ECOA aims to prevent discrimination in credit transactions based on race, color, religion, national origin, sex, marital status, or age. Which of the following actions could be considered steering under fair lending laws? Is it A. Offering a variety of loan products to all clients, B. Providing information about loan options, C. Directing clients to certain loans based on their race, or D. Recommending loans based on credit score? The answer is C, directing clients to certain loans based on their race. Why this question may seem a bit tricky. Steering involves directing clients to specific products or services based on discriminatory factors, which can be subtle. A loan officer suggests a minority client apply for a specific loan product that has higher interest rates, claiming it is the best option for them. What ethical issue does this scenario illustrate? Is it A, steering, B, redlining, C, predatory lending, or D, disparate impact? The answer is A, steering. This scenario illustrates steering, where the loan officer is directing the client to a product based on discriminatory factors. What does the term redlining refer to in the context of fair lending? Is it A, offering loans with high interest rates, B, providing loans only to high-income individuals, C, requiring excessive documentation for loans, or D, denying loans based on geographic location? The answer is D, denying loans based on geographic location. Redlining is the practice of denying services, like loans, to residents of certain areas based on racial or ethnic composition. During a loan application process, a client is consistently offered less favorable terms than others with similar credit profiles. What fair lending concern does this raise? Is it A, steering, B, disparate treatment, C, redlining, or D, predatory lending? The answer is B, disparate treatment. This situation raises concerns about disparate treatment, where individuals are treated differently based on prohibited factors. What is the primary goal of the Fair Housing Act? Is it A, to regulate mortgage interest rates, B, to prevent discrimination in housing, C, to provide subsidies for low-income housing, or D, to establish zoning laws? The answer is B, to prevent discrimination in housing. The Fair Housing Act aims to eliminate discrimination in housing-related activities, ensuring equal access to housing opportunities regardless of race, color, national origin, religion, sex, familial status, or disability. Which practice could unintentionally lead to a violation of fair lending laws? Is it A, offering different loan terms based on neighborhood demographics, B, providing equal terms to all applicants, C, using credit scores to determine loan eligibility, or D, requiring income verification for all applicants? The answer is A, offering different loan terms based on neighborhood demographics. Why this question may seem a bit tricky, the term unintentionally suggests a practice that might not be overtly discriminatory, but still results in disparate impact, such as offering different terms based on neighborhood demographics. A mortgage broker suggests a client choose a loan product with higher fees because it offers a quicker approval process. What ethical concern does this raise? Is it A, redlining, B, disparate treatment, C, steering, or D, predatory lending? The answer is C, steering. This scenario raises concerns about steering, where the broker may be directing the client towards a more expensive product for convenience, potentially violating consumer protection principles. Ethical advertising and borrower communication. What is the primary ethical concern when advertising mortgage products to potential borrowers? Is it A, maximizing company profits, B, ensuring advertisements are truthful and not misleading, C, targeting a specific demographic, or D, using complex financial jargon? The answer is B, ensuring advertisements are truthful and not misleading. The primary ethical concern is ensuring that advertisements are truthful and not misleading, as this protects consumers from making uninformed decisions. Which of the following is considered ethical borrower communication? Is it A, promising a specific loan rate before application? B, using technical terms without explanation? C, providing clear and accurate information about loan terms? Or D, omitting fees to make loans appear more attractive? The answer is C, providing clear and accurate information about loan terms. Why this question may seem a bit tricky. The options include subtle differences in communication practices, but ethical communication requires transparency and clarity. A loan officer is creating an advertisement for a new mortgage product and includes a low introductory rate without mentioning the subsequent increase. What ethical principle is being violated? Is it A, fair competition? B, confidentiality? C, non-discrimination? Or D, transparency? The answer is D, transparency. The omission of important information about rate changes is misleading, violating the principle of transparency in advertising. Which action is considered unethical in borrower communication? Is it A, providing incomplete information about loan terms? B, offering a detailed explanation of loan fees? C, using clear and simple language? Or D, responding promptly to borrower inquiries? The answer is A, providing incomplete information about loan terms. Providing incomplete information can mislead borrowers, which is unethical, as it prevents them from making fully informed decisions. During a consultation, a borrower asks about potential penalties for early repayment. The loan officer decides to emphasize the benefits of the loan instead. What ethical issue does this raise? Is it A, confidentiality breach? B, lack of transparency? C, discrimination? Or D, conflict of interest? The answer is B, lack of transparency. The loan officer's failure to address the borrower's specific question about penalties is an issue of transparency and full disclosure. A mortgage broker is designing a flyer for a new loan product and decides to highlight only the benefits without mentioning any potential risks or fees. What ethical issue does this raise? Is it A, ensuring borrower confidentiality? B, providing misleading information? C, offering competitive rates? Or D, avoiding conflicts of interest? The answer is B, providing misleading information. Omitting important information about risks or fees can mislead borrowers, violating ethical standards of transparency and honesty in advertising. State regulatory authority and license law. What is the primary role of the state regulatory authority in mortgage licensing? Is it A, to set federal interest rates? B, to issue, renew, and revoke licenses? C, to provide mortgage loans directly to consumers? Or D, to manage national housing policies? The answer is B, to issue, renew, and revoke licenses. The state regulatory authority is responsible for issuing, renewing, and revoking licenses, ensuring compliance with state laws. Which of the following actions would most likely result in a license revocation by the state regulatory authority? Is it A, failing to renew the license on time? B, charging slightly higher fees than competitors? C, advertising without a license number? Or D, engaging in fraudulent activities? The answer is D, engaging in fraudulent activities. Why this question may seem a bit tricky. While all options involve potential issues, only fraud directly violates licensing laws and ethics, leading to revocation. If a licensed mortgage loan originator moves to a new state, what must they do to continue practicing legally? Is it A, apply for a new license in the new state? B, notify the previous state of the move? C, continue practicing under the old license? Or D, wait for automatic license transfer? The answer is A. Apply for a new license in the new state. Why this question may seem a bit tricky, each state has its own licensing requirements, so transferring a license isn't automatic. Jessica, a licensed mortgage loan originator, receives a complaint from a client about a potential violation. What is her first step according to state regulatory guidelines? Is it A. Ignore the complaint if she believes it's unfounded? B. Directly contact the state regulatory authority? C. Report the complaint to her compliance officer? Or D. Resolve the issue personally with the client? The answer is C. Report the complaint to her compliance officer. Jessica should first report the complaint to her compliance officer or supervisor to ensure proper handling and documentation. During a routine audit, a state regulatory authority finds discrepancies in a licensee's records. What is the most likely immediate action? Is it A. Revoke the license immediately? B. Issue a notice of violation? C. Impose a heavy fine without notice? Or D. Ignore the discrepancies if minor? The answer is B. Issue a notice of violation. The authority will typically issue a notice of violation and request corrective action before considering more severe penalties. What is the primary function of the state regulatory authority in the context of mortgage licensing? Is it A. To provide mortgage loans directly to consumers? B. To enforce compliance with state-specific mortgage licensing laws? C. To set federal interest rates for mortgages? Or D. To offer training programs for mortgage professionals? The answer is B. To enforce compliance with state-specific mortgage licensing laws. The state regulatory authority's primary function is to oversee and enforce compliance with state-specific mortgage licensing laws and regulations. Which of the following is a responsibility of the state regulatory authority that might be misunderstood as a federal duty? Is it A. Setting national mortgage interest rates? B. Issuing licenses for interstate mortgage lending? C. Enforcing state-specific consumer protection laws? Or D. Regulating national mortgage-backed securities? The answer is C. Enforcing state-specific consumer protection laws. Why this question may seem a bit tricky. State regulatory authorities enforce state laws, which can be confused with federal oversight due to overlapping areas like consumer protection. Alex, a licensed mortgage loan originator, is notified by the state regulatory authority of a pending investigation into his practices. What should Alex do first, according to state regulatory guidelines? Is it A. Review the notification details and prepare to cooperate fully? B. Immediately cease all business operations until the investigation concludes? C. Hire a lawyer and refuse to communicate with the authority? Or D. Publicly announce the investigation to all clients? The answer is A. Review the notification details and prepare to cooperate fully. Alex should first review the notification details and prepare to cooperate fully, as transparency and compliance are crucial during investigations. Compliance standards and supervisory oversight. What is the primary purpose of the Uniform State Test in the context of mortgage licensing? Is it A. To increase the number of licensed mortgage professionals? B. To standardize the testing process across states? C. To reduce the cost of obtaining a mortgage license? Or D. To eliminate the need for continuing education? The answer is B. To standardize the testing process across states. The UST is designed to standardize the testing process across states, ensuring that all mortgage loan originators meet a consistent level of knowledge and compliance. Which of the following is not a component of the UST compliance standards? Is it A. Ethical conduct guidelines? B. State-specific regulatory updates? C. Requirement for annual audits? Or D. Continuing education requirements? The answer is C, requirement for annual audits. Why this question may seem a bit tricky. The options are closely related, but only one is not directly part of UST compliance standards, which is the requirement for annual audits. A mortgage loan originator in California is preparing for the UST. What should they focus on to ensure compliance with both federal and state regulations? Is it A, only federal regulations as they apply nationwide? B, primarily state regulations as they vary more? C, general mortgage industry practices? Or D, both federal and state-specific regulations? The answer is D, both federal and state-specific regulations. The UST covers both federal and state-specific regulations, so the originator should focus on understanding both aspects to ensure compliance. What role does supervisory oversight play in the context of UST compliance? Is it A, ensures adherence to compliance standards? B, reduces the need for regulatory updates? C, increases the complexity of the licensing process? Or D, eliminates the need for ethical guidelines? The answer is A, ensures adherence to compliance standards. Supervisory oversight ensures that mortgage loan originators adhere to compliance standards and regulations, maintaining the integrity of the mortgage industry. During a supervisory review, a mortgage company is found to have incomplete compliance records. What is the most likely consequence? Is it A, immediate suspension of all operations? B, increased scrutiny and potential penalties? C, mandatory retraining of all staff? Or D, no action unless further violations occur? The answer is B, increased scrutiny and potential penalties. Incomplete compliance records typically lead to increased scrutiny and potential penalties to ensure future adherence to standards. What is the primary focus of the Uniform State Test compliance standards? Is it A, ensuring adherence to federal and state regulations? B, providing financial incentives for mortgage companies? C, increasing the number of licensed mortgage loan originators? Or D, reducing the cost of mortgage licensing? The answer is A, ensuring adherence to federal and state regulations. The UST compliance standards primarily focus on ensuring mortgage loan originators adhere to both federal and state regulations, promoting uniformity and consistency across states. Which aspect of supervisory oversight is most critical in ensuring UST compliance? Is it A, providing training programs for employees? B, implementing a robust reporting system? C, conducting regular audits? Or D, establishing a compliance committee? The answer is C, conducting regular audits. Why this question may seem a bit tricky. All options seem important, but regular audits are the most critical, as they directly assess compliance adherence. A mortgage company in Texas is undergoing a supervisory review and discovers discrepancies in their compliance records. What should be their immediate focus to align with UST standards? Is it A, expanding their market reach? B, correcting discrepancies in compliance records? C, increasing staff training sessions? Or D, enhancing customer service protocols? The answer is B, correcting discrepancies in compliance records. The company should immediately focus on correcting discrepancies to ensure compliance with UST standards, as accurate records are crucial. State disciplinary actions and prohibited conduct. What is a common consequence for mortgage loan originators found guilty of prohibited conduct under state disciplinary actions? Is it A, a fine of up to $1,000? B, mandatory community service? C, suspension or revocation of license? Or D, public apology? The answer is C, suspension or revocation of license. State disciplinary actions often result in the suspension or revocation of a license for mortgage loan originators found guilty of prohibited conduct. If a mortgage loan originator is found to have committed fraud, what is the most likely immediate action taken by the state? Is it A, imposition of a monetary fine, B, suspension of the license, C, permanent revocation of the license, or D, issuance of a public warning? The answer is B, suspension of the license. Why this question may seem a bit tricky, the term immediate action might suggest a swift penalty, but the state typically first suspends the license pending further investigation. John, a mortgage loan originator, was found to have misrepresented loan terms to a client. What disciplinary action is most likely to be taken by the state? Is it A, revocation of his license, B, a written warning, C, a temporary fine, or D, mandatory retraining? The answer is A, revocation of his license. Misrepresentation of loan terms is a serious offense that often results in suspension or revocation of the license to protect consumers. Which of the following is considered prohibited conduct for a mortgage loan originator? Is it A, offering competitive interest rates, B, providing excellent customer service, C, attending industry conferences, or D, falsifying loan documents? The answer is D, falsifying loan documents. Prohibited conduct includes actions like falsifying documents, which is a serious violation of ethical and legal standards. Sarah, a licensed mortgage loan originator, was caught accepting kickbacks from a real estate agent. What is the most likely disciplinary action she will face? Is it A, a formal reprimand, B, a monetary penalty, C, suspension of her license, or D, requirement to return the kickbacks? The answer is C, suspension of her license. Accepting kickbacks is a serious violation that typically results in suspension or revocation of the license to maintain industry integrity. What is a common disciplinary action taken by the state against a mortgage loan originator who violates state regulations? Is it A, issuing a warning letter, B, suspending the license, C, reducing commission rates, or D, requiring additional training? The answer is B, suspending the license. States often suspend licenses as a disciplinary action to prevent further violations while investigating the issue. Which action is considered prohibited conduct for a mortgage loan originator under state regulations? Is it A, offering a lower interest rate, B, providing financial advice, C, accepting undisclosed fees, or D, referring clients to a specific lender? The answer is C, accepting undisclosed fees. Why this question may seem a bit tricky. The options include actions that might seem permissible under certain conditions, but accepting undisclosed fees is explicitly prohibited. Emily, a mortgage loan originator, was found to have altered client documents to secure loan approval. What disciplinary action is most likely to be taken by the state? Is it A, revoking her license, B, imposing a fine, C, mandating ethics training, or D, placing her on probation? The answer is A, revoking her license. Altering documents is a serious violation, often leading to license revocation to prevent further misconduct.
Thanks for watching. If you found this exam review helpful, be sure to subscribe for more real-world practice and topic-focused study videos. And visit Birdsy.ai to start your free trial of Birdsy, your AI-powered study partner.